President Trump just told big tech they have to build their own power plants. Meanwhile, housing stocks are crashing, and Nvidia is about to report earnings that could make or break the entire market. Welcome to the craziest closing bell of the year.
It is an absolute powder keg out there today.
Before we dive into the charts, remember, we are here to talk option strategies, cash-secured puts, and LEAP APS. But this is for educational purposes only. We aren't your financial advisors, so trade your own plan.
Right. So it is Wednesday, February 25th, 2026. The closing bell just rang, and the silence on the floor right now is deafening. But the noise on the trading screens, it is just getting started.
Oh, absolutely.
Because if you just, glanced at the headline indices today, you might think things are totally normal. The NASDAQ composite finished up, about 0.7%, and the S&P 500 tacked on 0.5%.
Yeah, that is the classic everything is fine headline.
Yeah.
But if you were actually trading this session, if you were in the trenches staring at the level 2 data all afternoon, you know that fine is the absolute last word to describe today.
Oh, without a doubt.
This market is completely schizophrenic right now.
Yeah.
It's entirely bifurcated.
It really is a tale of two economies happening simultaneously.
We have this massive divergence. On one side, you have the AI trade effectively holding its breath, turning blue, just waiting for Jensen Huang to walk out on stage in a few minutes.
Right.
And then on the other side, you have the real economy, specifically housing, getting absolutely taken up back and shot today. I mean, it was a bloodbath in the builder stocks.
It really was. And we need to dissect both of these because, look, for you guys listening, as options traders, volatility is our inventory. And today, the inventory is stacked to the ceiling.
Totally.
But the catalyst for all of this, the real reason the board looks the way it does right now, it started last night. We really have to go back to the State of the Union address.
President Trump's ratepayer protection pledge.
Yeah.
Let's unpack this right away. Because when I first heard it last night, I honestly thought it was just a throwaway line.
A lot of people did.
Right. It sounded like standard campaign rhetoric. But the market took it very, very seriously at the open today.
Because it's not just rhetoric. It's a structural shift in how the American power grid is actually going to operate from here on out. The president drew a hard line in the sand.
Yeah.
He announced a mandate that major technology companies, the AI developers, are going to be required to fund their own electricity uses.
Required to fund. That is the key phrase right there.
Yeah.
So the translation for the market is basically you want to build the matrix. Great. You pay for the batteries.
Yeah.
You do not get to plug into the same outlet as the rest of us.
That is the layman's translation, yes. Exactly. Let's look at the actual mechanism here because this is where the rubber meets the road for your Microsofts and your Amazons. The logic Trump laid out is that the U.S. power grid is old. He stated we have an amount of energy demand that has, quote, never been needed before.
Which is true.
It is entirely factually correct.
Yeah, we've seen the charts. The Lawrence Berkeley National Laboratory data is pretty undeniable at this point.
Right. Data center demand doubled between 2018 and 2024, and it is actively on track to triple by 2028. We are talking about gigawatts of power.
Just massive, massive scale.
To put that in perspective for everyone, a single gigawatt power is roughly 750,000 homes. These new data center clusters they're building, they are demanding multiple gigawatts each.
But here's the friction point, right? Trump promised on the campaign trail to cut electricity bills in half. That was the stump speech. I will slash your energy bill.
Yes.
But the reality check is that retail electricity prices are actually up 6% year over year. People are opening their mail, they're seeing their utility bill, and they are getting angry. They see a massive data center being built down the road, and they immediately connect the dots.
Exactly. It becomes a massive political liability. So this ratepayer protection pledge is essentially the White House's way of solving that political equation. He is saying, okay, big tech, you are paying for your own juice, so grandma's heating bill doesn't go through the roof.
Well,
He claims that with this pledge, residential prices will not rise, and they might even fall.
but hold on a second. Is that actually enforceable? I mean, you can't just tell Microsoft, hey, go build a nuclear plant in Virginia. That takes 10 years of permits alone. Is Trump saying they have to cut the ribbon on a reactor tomorrow? Or is this just political theater that the algorithms are overreacting to?
It sounds like theater on the surface, but the leverage is in the grid connection queue. That is the actual choke point. The federal government, through FERC and the various independent system operators, they can make life very, very difficult for anyone trying to connect a 500 megawatt load to the public grid.
Oh, interesting. So they just deny the plug-in.
Exactly. Trump is effectively using this pledge as a gatekeeper. If you want the permit to plug your AI data center into the PJM grid, you have to prove you are bringing your own electrons to the party.
You mentioned PJM. Let's go deep on this right now because I saw a statistic cross my desk today that completely blew my mind. And I do not think most retail traders realize how broken the grid pricing model is right now.
This is the critical piece of macro data for the tech trade. PJ Interconnection is the largest grid operator in the country. It covers a huge chunk of the East Coast and the Midwest. Basically, it's where all the major data centers in Northern Virginia and Ohio are located.
Okay, so ground zero for AI infrastructure.
Exactly. Now, in the wholesale electricity market, you have two different things you pay for. You have the price of energy, which is the actual electrons you consume, and you have the price of capacity.
Break that down for the listeners who don't normally trade commodities.
Yeah.
What is the actual difference between energy and capacity?
Think of it like a nightclub. Energy is what you pay for the drinks once you are already inside.
Okay.
Capacity is what you pay the bouncer at the door just to keep the club open and ensure there is actually room for you to get in. Capacity is the price utilities pay to generators just to ensure there is enough power on standby. These are power plants that might not run every single day, but they have to be there for the hottest day in July when everyone turns on their AC.
Got it. So it's an insurance policy, it's a retainer fee for the grid.
Precisely. PJM holds an option to decide how much that bouncer costs. For the 2024 to 2025 period, the price was $28.92 per megawatt day.
$29. I mean, that's basically nothing. In the grand scheme of utility costs, that is a rounding error.
It was dirt cheap because we had a massive surplus of power for years. But now, old coal plants are retiring rapidly because of age and environmental regulations. At the exact same time, AI is screaming for new power, so that surplus is completely gone. For the 2026 to 2027 period, the auction that just happened, that price jumped to $329.17.
Oh, whoa, stop right there. From $28 to $329, that is more than a 10x move. That is a 1,000% increase in the base cost of grid reliability.
It is absolutely explosive. And that price signal right there is telling you everything you need to know about why this White House mandate is happening. The grid is stressed to the breaking point. If the hyperscalers, Amazon, Microsoft, Google, Meta, Fidelity, if they just kept plugging into the public grid without adding their own new capacity, the system would physically collapse. Or prices for regular people would skyrocket even further.
So to use your analogy, the bouncer at the club is now charging 10 times as much just to get in because the club is full and there's a line of billionaire robots outside trying to get through the door.
That is a very, very accurate analogy, and that brings us directly to the corporate response. Because of this pricing pressure and now this political mandate on top of it, we are seeing the tech giants essentially morphing into utility companies in real time.
Yeah, we're seeing deals everywhere. They are building gas generation, I think something like 5 gigawatts of it. They are upgrading nuclear plants for another 6 gigawatts. They are building massive battery storage facilities.
The hyperscalers have already planned a collective $650 billion in AI capital expenditures for 2026 alone. A huge chunk of that, probably a much larger chunk than anyone on Wall Street anticipated 2 years ago, is now going to be pure energy infrastructure.
So let's bring this back to the trading desk. What does this actually mean for us as options traders? Because to me, this screams moat, M-O-A-T. If you are a hot new startup trying to compete with Microsoft or Google today, not only do you need to buy the H100s or the Blackwell chips, but now you apparently need to go build a nuclear reactor too.
It absolutely cements the dominance of the incumbents.
Right.
Only the largest balance sheets on the planet can afford to vertically integrate their own power supply like this. It turns big tech into a heavy industrial sector. They are managing physical infrastructure now, not just writing code. You can't just spin up an AWS instance and hope to compete with Gemini or GPT-5 if you can't guarantee the raw power to run the training models.
Which makes them infinitely more capital intensive, but also way harder to displace. From an options perspective, looking at Lee Paris, this makes me look at the Magnificent Seven as even safer long-term holds. They aren't just software companies anymore. They are building the rails, the trains, and the power plants.
It certainly changes their risk profile. It lowers the risk of disruption by a new competitor, but it also lowers the return on invested capital in the short term, simply because concrete and steel are really expensive. But look, while tech is out there building nuclear plants and printing money, The housing market is looking like a total demolition site today.
Yeah, we have to pivot to the carnage. Because while the Nasdaq was busy rallying on this tech strength, the housing sector got absolutely gutted. The S&P Composite Homebuilder Index shed up to 5.2% in a single session today.
That is a massive, massive move for a broad index. The individual names were hit even harder.
I was watching the tickers all afternoon. Lennar, ticker LEN, Green Brick, GRBK Lowe's, LOW. Just ugly, ugly red candles straight down. It felt like the bottom completely fell out. This wasn't just random market noise. This was a direct reaction to earnings in the State of the Union speech.
It was a brutal 1-2 punch for the sector. First, you had the earnings data. Lowe's reported this morning. They actually beat the analyst estimates on the bottom line, but the forward forecast was incredibly gloomy. They are actively predicting a decline in sales.
And Home Depot said the exact same thing earlier in the week. Their CFO, Richard McPhail, was talking about, quote, growing uncertainty. He specifically mentioned affordability issues and, worryingly, concerns about job losses. When Home Depot starts warning about job losses, you have to pay attention. That is the real physical economy talking to you.
And Lowe's CEO Marvin Ellison explicitly mentioned the persistent lock-in effect of high mortgage rates.
Okay, let's dig into this lock-in effect, because I think it's misunderstood. We hear it on the financial networks all the time. People are locked in. But I've always heard the counter-argument from the bulls. If people are locked into their 3% mortgage and they can't afford to move, won't they just remodel their current kitchen instead? Shouldn't that actually help a company like Lowe's? Why is Lowe's crashing if everyone is staying put?
You would naturally think so, and frankly, that was the bull case for the sector for a while. Improve, don't move. But you have to look at how the average consumer actually pays for that new kitchen.
Right. It's not usually cash.
No, most Americans do not have 50 grand in cash just sitting in a checking account for a kitchen renovation. They use leverage, they use home equity lines of credit, ELOLs.
And ELOAC rates are definitely not fixed at 3%.
Exactly. HELOCs float. They are strictly pegged to the prime rate. So sure, you have a beautiful 3% mortgage on your main note, but if you want to tap your home equity to buy new cabinets and quartz countertops, you are borrowing that new money at 9%, 10%, maybe even 11% right now.
Ouch. So the golden handcuffs of the fixed mortgage keep you trapped in the house, but the high variable rates keep your wallet firmly shut for renovations.
Precisely. It creates a total zombie housing market. Nobody moves, nobody builds, and nobody fixes anything. And that is exactly why Lowe's is seeing those massive red candles. The sheer cost of money is strangling the physical economy.
And then, just to add insult to injury for the home builders today, the market was really hoping Trump would throw them a lifeline in the State of the Union.
Investors were definitely pricing in some hope there. They thought maybe we'd get a tax credit for first-time buyers or maybe a targeted construction incentive. Instead, they got almost nothing.
He mentioned potentially banning institutional investors from buying single-family homes, which sure sounds highly populist. Wall Street shouldn't own your neighborhood. But does that actually lower the mortgage rate for a guy in Ohio trying to buy his first starter home?
Not immediately, no.
Yeah.
And arguably not enough to move the needle on broad affordability. In fact, some economists argue if you remove a massive source of capital from the housing market, you might actually slow down new construction even more. But the real blow for the builder stocks was his comment on interest rates. He basically abdicated all responsibility for housing.
Yeah, the quote was wild.
He stated, and I quote, "Lower interest rates will solve the Biden-created housing problem," and effectively punted the entire issue straight over to the Federal Reserve.
He is totally washing his hands of it. Hey, pal, this is your mess, you fix it. And the market absolutely hated that because the Fed has been incredibly sticky. Rates are not coming down anywhere near as fast as the home builders need them to.
And that dynamic creates this massive, glaring divergence we are seeing across the board today. High interest rates are actively crushing the physical asset economy, housing, construction, renovation. But those exact same rates are not stopping the AI trade, because the AI trade is fueled by cash-rich, mega-cap giants who do not need to borrow money at 8% to build their data centers. Microsoft has billions in cash on hand. Lennar relies on normal people getting 30-year mortgages.
Right. Microsoft is not going to their local credit union to take out a mortgage to buy Nvidia chips. They are just writing a massive check.
Exactly. So for our listeners out there who love selling options premium.
This is the classic don't catch a falling knife warning.
Yeah.
Listen up. I know a lot of you guys like selling puts on home builders because they have low PE ratios and they look optically cheap. You look at the chart and go, oh, Lennar is down 5% today. I'll just sell the 140 strike put and collect some juicy premium. But when the macro policy support evaporates and the corporate guidance is explicitly gloomy, that premium is not worth the risk. You are stepping right in front of a freight train.
I completely agree. The premium right now is much more attractive and frankly much safer on the side of the market that actually has massive secular tailwinds behind it. Which brings us perfectly to the main event.
The big one, the absolute closing bell chaos creator, Nvidia.
They are reporting right now as we speak. The numbers should be crossing the wires any second.
Let's set the stakes here for anyone just tuning in. Nvidia is the most valuable company in the world. The market cap is hovering around $4.8 trillion. Just to put that in perspective, that is bigger than the entire GDP of Germany. It's bigger than the entire French stock market combined.
It is the ultimate gut check for the entire AI trade. We saw the NASDAQ rally today specifically into the print, which is always a bit nerve-wracking for traders. Nvidia stock was up about 2% into the close, sitting right around $196.73.
The expectations are just astronomical. We are looking for revenue to jump 68% year over year to roughly $65.8 billion. Just think about that growth rate for a second for a company of this sheer size. Usually when a company gets this big, you are happy if they grow at 5 or 10%. They are growing like a microcap tech startup. And EPS is expected to jump to $1.53, up from 89 cents a year ago. Data center revenue alone is projected at $60.2 billion. But look, as always with Nvidia, the headline numbers are just the appetizer. The market algos are going to be hyper-obsessed with two specific things deep in the report: margins and forward guidance.
The magic number is 75%, right?
That is the strict consensus for gross margin, 75%. Investors need to see that they can maintain that insane profitability even as they transition and ramp up production of the new Blackwell chips. There's been some background concern that production costs are rising. TSMC is charging more for fabrication. The advanced packaging is much more complex. All of that could compress margins. If they print at 74% or 73%, the algos might aggressively punish the stock, even on a revenue beat. And speaking of Blackwell, everyone on Wall Street is looking for any mention of Blackwell Ultra.
Correct. The analysts over at KeyBank have been heavily highlighting this in their notes. They expect the Blackwell Ultra product cycle to be the key driver for the next leg of massive growth. It carries a 20 to 30% higher average selling price, or ASP, than the standard Blackwell chip.
That is just pure, unadulterated pricing power. Hey, you like the incredibly fast chip? Well, here's the slightly faster one. It costs 30% more, and by the way, there is a line out the door to buy it. But I want to talk about why that line is out the door.
Yeah.
Because we keep hearing this phrase, agentic AI, everywhere lately.
Yes. This is definitely the buzzword of the quarter, agentic.
You used it earlier regarding the Samsung Galaxy S26 launch.
Yeah.
But let's go deep on this for the listeners. We hear this term thrown around constantly. How is agentic AI actually different from just asking standard ChatGPT to write me a funny poem? Why does an agent require so many more NVIDIA chips than a standard chatbot?
It comes down to a massive step up in compute intensity per query. When you ask ChatGPT for a poem, it is a simple direct input-output loop. You send a text prompt, the model predicts the next words based on probability, and it sends the text back. One shot, done. An agent, however, has to actually reason and plan multi-step workflows.
Give me a real-world example. Make it tangible for us.
Okay, take the new Samsung S26 integration. They are aggressively pitching the S26 as a proactive lifestyle assistant. You tell your phone, book me a dinner for two at a quiet Italian place near the downtown cinema, and get us an Uber to be there by 7 p.m.
Okay, sounds simple enough.
For a human, yes. But for an AI model, that is a highly complex chain of logical operations. The AI isn't just looking up a fact on Wikipedia. It has to, first, find the cinema location. Second, search OpenTable via an API for available slots that geographically match that area. Third, it has to check Uber wait times and live traffic data. Fourth, it has to coordinate the restaurant reservation time perfectly with the car arrival time. And finally, it has to actually execute the financial transactions to book the table and call the car.
Wow, okay, so it's acting like a literal human executive assistant. It is managing a workflow, not just answering a trivia question.
Right. And mechanically, inside the cloud data center, that single voice request from your phone might require 10, 20, or 50 distinct inference steps in the background. The model has to think about the plan, check for API errors, self-correct if a restaurant is full, and confirm every single step.
Ah, I see the connection now. One simple user request equals 50 separate pings to the Nvidia chip sitting in the server rack.
Exactly. That is the massive multiplier effect the market is betting on. If agentic AI actually works at scale, the demand for inference compute doesn't just grow linearly with new users. It grows exponentially with the complexity of the daily tasks. If Samsung, and presumably Apple very soon, are pushing these AI agents out to billions of smartphones, the sheer demand for NVIDIA's inference compute is not going away anytime soon. It is literally just starting.
It totally validates the CapEx. It validates that entire $650 billion the hyperscalers are spending. They aren't just building empty data centers for fun. They are building the heavy infrastructure needed to serve as the brains for your phone.
Which brings us perfectly back to the trade setup for tonight. The implied volatility, the IAV, on NVIDIA options going into this print was just insanely high.
Insane is honestly the best word for it. If you look at the options chain, the market is pricing in a 5% move by tomorrow morning. For a $4.8 trillion company, a 5% move is, that's roughly $240 billion in market cap swinging around. That is like creating or destroying the entire value of a Netflix or Coca-Cola in 10 minutes of after-hours trading.
And historically, the average daily move for NVIDIA has only been about 3%. So the options premium is heavily, heavily juiced right now. This is a classic textbook setup for what we call an IV crush.
For the newer listeners tuning into Theta Fuse, let's unpack IV Crush quickly, because this is the absolute bread and butter of our trading philosophy. Before a massive binary event like earnings, everyone gets scared. Uncertainty is at its absolute peak, so retail and institutions alike, they buy puts and calls for portfolio protection or speculation.
Right. Demand for options goes through the roof, so the base price of those options goes up entirely independent of the stock price. That is basically Vegas raising the price of a bet right before the Super Bowl kickoff.
Exactly. But once the earnings numbers are actually out, whether they're good, bad, or neutral, the core uncertainty vanishes instantly. The game has officially started. The volatility balloon just pops. The price of those options collapses almost instantly at the open tomorrow, even if the stock price moves a little bit in either direction.
And as premium sellers, we want to be the ones aggressively selling that expensive balloon right before it pops. We're systematically selling the volatility.
So the strategy here, if you are bullish to neutral on the AI thesis, is selling far out of the money puts. You are betting the stock won't absolutely crash 10 or 15% overnight. But let's play devil's advocate for a second. We sell the put. We are banking on the IV crush.
Yeah.
But what if Jensen Huang walks out on the call and says, guys, the party is over, demand is softening. What if the stock legitimately drops 15%?
That is where the fuse part of the Theta Fuse strategy comes in. You are not selling naked puts, or at least you absolutely shouldn't be unless you have a massive portfolio margin account and you actively want to be assigned 100 shares of NVIDIA at that strike price. You are selling a spread.
Define that structure clearly for the new traders listening.
You sell the put option at, say, the $180 strike to collect that fat premium. But you simultaneously buy a protective put option at the $170 strike. You are strictly capping your downside risk. If the stock unexpectedly goes to zero tomorrow, you do not lose your house. You only lose the width of that strike spread minus the initial credit you received up front.
So you are totally willing to cap your maximum upside, which is the premium collected, in order to strictly define your worst-case scenario downside.
In this current market environment, absolutely. With this much macro geopolitical noise and Trump actively changing the energy rules on big tech overnight, you want a hard floor under your trades. But look, there is another very compelling angle here for the long-term believers, especially if we get a post-earnings dip.
The leap PS.
Yes, long-term equity anticipation securities. The historical data on holding NVIDIA options for a year is just staggering. Historically speaking, a one-year hold on NVIDIA LEPS bought right before an earnings print carries a 93% median return with an 84% historical win rate.
An 84% win rate.
Right.
Those are the kinds of statistical odds the casino house usually keeps for itself.
It heavily implies that the recurring scare trade, this constant media narrative that AI is just a massive bubble about to burst, has consistently been the wrong side of the bet. The market frequently rotates out of perceived losers and panic sells on slight margin misses, but the fundamental underlying growth trajectory of NVIDIA compute keeps correcting the stock price higher over a 12-month window.
So if we do see a knee-jerk algorithmic reaction tonight, say, gross margins print at 74.8% instead of 75, and the stock immediately dips 5% after hours, that is your signal to start looking at deep-in-the-money loops tomorrow morning. You buy a call option expiring deep into 2027 or 2028, you control 100 shares of the underlying stock, but you only put up a fraction of the capital required to actually buy the shares outright.
It is a highly capital-efficient way to leverage the long-term growth story without suffering the daily emotional stress of the weekly chart fluctuations. But of course, you have to have the high conviction that the end demand, the Samsung agentic phones, the massive meta data center deals, the physical nuclear power plants being built is actually real and sustainable.
And based on the sheer fact that Microsoft is literally out there funding the construction of nuclear reactors, I genuinely think the demand is real. They are not doing that for a passing software fad. You do not pour thousands of tons of concrete for a nuclear plant just to support a bubble.
Agreed. The physical infrastructure build-out is the ultimate tell here.
Okay, before we completely wrap up and wait for these numbers to hit the tape, we have to briefly touch on the broader macro picture, because there is some serious background noise today with tariffs and crypto.
Right. The Supreme Court ruling on tariffs this morning was a highly significant constitutional moment. They officially struck down President Trump's use of the IEEPA, the International Emergency Economic Powers Act, to enforce his sweeping tariffs.
Which on paper sounds like a massive win for free trade. The equity markets usually love that kind of deregulation news.
In theory, yes, it should be bullish. But the White House immediately pivoted. The U.S. Trade Representative, Jamieson Greer, came out and explicitly said they are utilizing, quote, alternative methods to keep the targeted tariffs on China exactly where they are currently, which is between 35% and 50%.
So the legal mechanism changed, but the actual tax at the border remains exactly the same.
Exactly. And the baseline global tariff is actually bumping up to 15% temporarily. So the underlying inflationary pressure from these tariffs is absolutely not going away. That means the CPI data might stay uncomfortably sticky, which directly means the Fed cannot cut interest rates aggressively.
Which circles right back to why the housing market is totally stuck in the mud. It is all deeply connected.
It truly is an interconnected web.
And what about in the crypto world today? I saw Bitcoin finally broke its losing streak.
We did see a bit of a relief rally in Bitcoin, yes, but the really interesting move under the hood is the sector rotation. Broader liquidity is tightening a bit, but active crypto traders are migrating heavily into altcoins like Solana right now because they offer native yield. It is a desperate search for real yield in a persistently high-rate macro environment.
It makes perfect sense. When macro liquidity tightens, market volatility naturally increases. That is the golden rule. And for us options traders, elevated volatility equals elevated opportunity.
Precisely. It expands the premium on the board.
Okay, let's bring it all home. We are actively living through a historic market transformation right now. We literally have boring utility companies morphing into high-tech players. We have mega-cap tech companies morphing into heavy industrial utilities. We have the physical housing market screaming for Fed intervention, while the AI sector is just screaming for more silicon chips. And sitting right in the absolute dead center of it all is Jensen Huang and Nvidia.
The earnings call audio feed is opening up any minute now. These numbers will be the final market verdict on whether this AI trade has the legs to run for another solid year, or if the sector needs to take a serious valuation breather. But look, regardless of what the final print says, the core trading strategy remains exactly the same. Manage your downside risk strictly, actively look for the options premium that is severely overpriced due to retail fear, and generally speaking, do not bet against the companies actively building the future physical infrastructure of the world.
And whatever you do not sell naked puts on home builders in this rate environment. Just don't do it.
Very sound financial advice to end on.
All right, we want to hear from you guys. We want a simple yes or no in the comments right now. Yes or no, does Nvidia CRUSH earnings tonight and save the AI trade? Drop your answer below.
Let's see what the tape says.
Keep your theta positive and your stress negative. We'll see you on the other side of the print.